All right, well, let's just jump into it. So the focus of today's topic is non-recourse financing for self-directed retirement account investors. We're very pleased to have Roger St. Pierre from myiralender.com. The presentation is being provided for educational purposes only, not for tax, legal, or investment advice, nor as a solicitation. When making an investment decision, please consult with your tax attorney and financial professional. So what we're going to do, because of the audio difficulties, is we're going to have me speak at the beginning, and then we're going to turn the microphone over to Roger, and he'll do most of the talking. I'll try to jump in here and there, but again, we've got a little bit of technical difficulties. So we'll first start off with defining some of the terms. So what is a non-recourse loan? So this is when a loan is made to your retirement account, like your solo 401k or IRA LLC, for use in investing in physical real estate. So the loan is not made to you personally. It's made to your retirement account. It could be to your retirement trust. It could be to the LLC that's owned by your IRA. And it's non-recourse, meaning you're not personally guaranteeing it. The only recourse really of the lender is to go after the property itself. So that means they're going to price it differently. And Roger's going to give us a lot more detail on through an example when he takes over with his slides. So here, we're again just trying to set the stage in terms of the basics. So why would somebody use non-recourse financing? So it's leverage, right? By utilizing debt financing, you have more retirement funds for investing in real estate or other investments. So the rules don't allow a retirement account holder or a related person or entity like your business or close family members to loan funds to the retirement account. So generally the only option is non-recourse financing. So what we want to do now is go through some slides that go through the steps, again, to kind of lay the educational foundation so we can understand more about the good information that Roger's going to tell us. So we're going to first talk about the steps from a solo 401k perspective. Then we'll have a couple of slides to talk about the steps from an IRA LLC perspective. So a solo 401k is for a self-employed individual with no full-time W-2 employees working for any business owned by that person or a spouse. So if that person wants to invest in real estate and use non-recourse financing, they would first have to open up a self-directed solo 401k. So we're talking about a solo 401k from a provider like us that allows you to invest in real estate. You can't set up a free solo 401k like Fidelity or Schwab and invest in real estate. Then they need to fund that self-directed solo 401k, which they can do by making contributions, rolling over money from an existing retirement account, like a former employer plan or a non-Roth IRA. You can't roll over money from a Roth IRA to any type of 401k. Then they need to shop for a non-recourse lender. Then, for example, my IRA lender, which is where Roger's from, they've listed here. There's, you've also then got to put together your offer, the contract. These are very high level steps here. Then you make the deposit, the loan is funded, you close on the property, and you're buying it in the name of the plan. Your trust, your plan is the party that's the borrower that's obligated to pay back that loan. If you're not eligible to set up a solo 401k, because say you got employees or on the other spectrum, let's say you're not self-employed, or let's say you have Roth IRA money, but you still want to invest that money in real estate and use non-recourse financing, then the way to do it is through a self-directed IRA. So we offer a self-directed IRA LLC, which could be a Roth IRA LLC. So the steps to fund that would be open up the self-directed Roth IRA account. It's got to be at a specialty trust company or custodian, for example, Forge Trust, where they're going to allow you to invest in a brand new LLC. So let's say you get the Roth IRA open, you fund the Roth IRA. On a parallel path, the LLC is being established with the Secretary of State. You open up the LLC bank account, and then you wire the money from the Roth IRA account at the specialty trust company or custodian over to that LLC bank account. Ultimately, you have an LLC that's owned by your Roth IRA. The LLC, the member of that LLC is your Roth IRA, and you're the manager, and that's how you have checkbook control. Now you can start making alternative investments in the name of the LLC, including leverage real estate. So then it's a similar process, right? You're back to shopping for the non-recourse loan, negotiating the contract, the offer to buy, the earnest deposit. You're putting together all the documents that the bank needs. Maybe that's the appraisal, maybe that's the insurance, etc. And then you close on that purchase. And then the title's transferred to the LLC that's owned by your IRA. Then now you own the property through your retirement account. So that loan needs to be paid back. Of course, it has to be paid back using solo 401k or IRA LLC funds coming from that bank or brokerage account in the name of the LLC that's owned by your IRA or the solo 401k, whichever is applicable. You want to make sure that you plan accordingly, right? Because you have to use the retirement money, you can't just all of a sudden decide you're going to make payments out of your personal funds, right? So you want to budget accordingly, make sure you got good cash flow to be able to support that non-recourse loan and those payments. And then of course, remember that other expenses related to this investment, the mortgage, which is, the non-recourse loan, the property taxes, the insurance, other expenses like HOA fees, repairs, all the income and expenses related to the property that's owned by your retirement account, all that money is going to go in and out of the retirement account. So it's either going to go in and out of the 401k account, or it's going to go in and out of the LLC bank account that's owned by your IRA. Okay, so fantastic. So now we've set the stage with the basic understandings. And I would really encourage you to ask questions if you brought any, or if any come up as we're going through these slides. If you're going to ask questions, I would please ask you that you chat them over to the Zoom feature so we can field them in an orderly fashion. It looks like my audio is working for you now too, Roger. So that's great. It
sure is. Yep.
Okay, fantastic. I'll still try to let you speak and not interrupt too much, but I'm sure I'll have a few questions here or there. We also have slides that Roger brought. So I'll flip the slides, Roger, but whatever pace you want to go. So I'm going to flip over to your slides now, okay?
Sounds good. And thank you, George, for the introduction. I'm Roger St. Pierre with First Western Federal Savings Bank. Our domain name on the website is myiralender.com. And we've been a nationwide non-recourse lender since 2008. And so we've got a wealth of experience in this sector. We've been doing it a long time. And we've been a portfolio lender for over 40 years as a bank. So we're used to keeping our loans on our own books because there's no secondary market for a non-recourse loan that you folks will be using to leverage your real estate. You'll need to find a portfolio lender that can keep the loan on their books and provide the financing. So we're a nationwide lender. We lend in every state in the country except for New York State. And my disclaimer slide, which I think went by earlier, is, and we are here, we're not qualified to provide IRA rules, regs, eligibility, consult your tax and investment advisors. We're bankers, we're lenders. And so I try to make that distinction that we're a lender. We're not an expert in solo Ks or IRA LLCs like George is. Next slide, George. So what's a non-recourse loan? George has talked about and introduced the topic. Essentially what that means is a non-recourse loan is a loan that's secured by the collateral, but in the event that the payments are not made or there's a default, the bank cannot go back to the borrower of the loan to collect the loan. All we can do is foreclose on our property if it's collateral real estate, sell the real estate, whatever the proceeds are, that's what we get, and that's it. We can't go after any debtor for any deficiency balance. And when you're signing a loan document as a borrower on behalf of your trust, your solo 401k or IRA LLC trust, all you're going to sign, if you're an IRA, is you're going to sign as read and approved. But if you're signing as your trustee, you are the trustee for that solo K. But I can't come back to you as the trustee and come to you to repay the loan. If there's no more money in the trust to pay the payments, there's no more money, and that's it. It's a non-recourse loan, so the bank has no recourse against you, the person, and that's the distinction. You personally are not liable for any leveraged borrowing that you do through your solo 401k trust or IRA LLC. Next slide.
Great explanation. Thank you.
Yes. And I just want to touch on one tiny thing about that. There is a non-recourse loan in many markets for residential mortgages, but that's not the same kind of a loan as an IRA LLC or 401k trust loan. So just be aware of that. The entities that are eligible for non-recourse loans through our bank is any self-directed IRA of any type, traditional Roth, inherited, simple, solo 401ks. We can lend to IRA LLCs, checkbook IRAs. So largely through solo 401ks and IRA LLCs that George and Solo, his company sets up for you folks, you have the entity you need. Now it's just a matter of if you need financing, our bank is available to do that. And we support your kinds of accounts that you have. Next slide on this.
But
Go ahead, sir.
But if you're new, talk about the New York for a minute. So does that mean if the property's in New York, then you're excluded, or if the LLC's in New York, but they want to invest in New Jersey? If the property, and that's a good distinction, George, the property is located in New York, we can't lend on it. But if you live in New York, if your trust is domiciled in New York, that's fine if your property's out of state. It's just that New York State has got some pretty rough laws in terms of, let's just say that they favor the borrower. And so as a lender, it takes us 3 or 4 years to collect a loan if it goes south in New York State. And we just don't want to wait 4 years to collect a loan. But it's a function of their legal system. It's nothing else against New York State. So yeah, it goes back to, I would assume, the fact that the only recourse of the bank is being able to foreclose on the property. So if the state has made it so expensive to foreclose on the property or so difficult, then essentially they're just going to walk away from the state.
We choose not to do business, or yes, because it takes about 3 years to get your property back. And then meanwhile, you got to pay all the expenses and as it goes south.
And just to clarify, the 401ks are federal retirement trusts, so they're not domiciled in any state.
That's a good point, George.
So it's all about the property, though. So if you live in Manhattan, but you want to buy a condo in Miami through your retirement account, subject to all the good things that Roger's going to tell us, theoretically, you could get a non-recourse loan for that. You're not shut out because it's all about where the property is what I'm hearing Roger say.
You're right. In real estate, it's location, location, location. You got it.
Awesome. Okay. Next slide.
Please.
Thank you.
So eligible types of properties, we've talked about that we lend in 49 states. And then, so what kind of properties do we lend on in these states? Let's start with residential, because that's the most common asset that people with self-directed retirement trusts and plans buy is single-family residential real estate. They're familiar with it. They're comfortable with it. I would suggest to you that the people that we finance, the majority of them already own residential real estate personally, and they have experience in that. And so now they're branching out and accessing another pool of money, and that pool of money is the retirement assets. So usually investors in this space have investment experience in real estate. They've been doing it a while, and largely that experience is in single family and small multifamily properties. And so when they move then into borrowing money and accessing and acquiring assets within their trusts, typically I see them doing that, starting with single family real estate, could be a duplex, condos, apartments. So residential is the number one category of real estate that we finance, and it can be anything from a single family through a 20-unit apartment complex. Condos are fine, multifamily is okay. Also, we'll do commercial buildings, and oftentimes we get requests for commercial condos. An investor wants to buy a condo a commercial condo in a complex that has, let's say, medical offices. And so they would get a doctor that might lease that condo from their 401k trust. Or retail, some retail, I have some loans on some retail commercial centers. So commercial is fine. We have a 50%, and I'll get into this just a touch later, but a 50% leverage available on commercial. And then there's ag, and there are some customers who are familiar with ag, they're comfortable with ag, and they'll buy some ag land and then lease that out to a farmer, or there may be a farmer already operating a piece of ground and the owner decides to sell it. And the retirement plan investor will buy the property, has a lease with the operator who's going to farm that property, and that operator pays typically the owner a yearly lease payment in about October or November when their crops come in. And so you can own ag land with your solo 401k, and we'll support that kind of a property.
Great.
Next slide. So there's typically in the residential world, personally, you have down payments often around 20%, sometimes less. In the IRA world, on the other hand, we require considerably more down in that the typical down payment is 40%, not just 20. So just a second, George, I got a little dual control on my computer nowadays, and sometimes if I wait more than a few seconds on my computer, it shuts my screen down. So now I got to go back through. I just did that. Sorry about that. If I don't keep activity going on my computer, it times myself out. And in the interest of security, we have dual controls, which sends a little text to our phone that we've got to hit to open it back up. I'm open. Anyhow, that said, 40% down is the norm. You have 50% down, like I mentioned, on commercial. So we will typically do a 60% loan to value is basically the situation. Go ahead.
Oh, no, just listening. I'm sorry. And I guess my only comment there is I think for us, sometimes we have the conversation where the person's surprised by that, right? Because it goes back to what you said, right? You know, this is not the first time they've invested in rental real estate. You know, this is what they know. This is, you know, they might be a realtor who's self-employed and they know real estate. They want to invest their retirement money in real estate because they feel like they maybe know it better than the stock market. They've already done it. Maybe they've already gotten financing, but the terms have been different. And so they may come with predisposition and expectation. And then once they hear this, it's like, okay, I got to go back to the drawing board, you know?
And that's true, George, although I don't find much resistance. Once I explain that we're in a different lending world, when you get into the non-recourse world that we're in, people don't seem to have an issue with that. But yes, they are coming to the party from a mindset of a 20 to 30% down, and that's their mindset. And so it's a little bit of just an initial hurdle to say, no, that's not quite enough. You're going to have to plan to do 40% down if you're going to be financing in this world. And that's not an issue for most people.
And historically, that's always been like that, pretty much?
Yes. In the almost 15 years that we've been lending in this space, that's been our norm. Other lenders that I'm aware of in this space, that's also their norm as well. There may be an exception here and there, but that typically is the norm. In addition, just like on any other real estate piece you're purchasing, you're going to have your closing costs. And generally, I figure about 3% of purchase price is what I see nationally, just as a ballpark. So when you're building in the funds needed for a given piece of property, be sure to add in your closing costs. The other thing too is, as you know, or you may not know, once you buy a piece of property in your IRA and it may need some work on it, it may need some repair, you can't use your own money when Joe the plumber comes over and installs that new $1,500 hot water heater. You have to pay any bill, plumbing, anything with your retirement plan funds. So we as a lender require that you leave 15% of the loan amount still in the account as reserves. For example, and I'll get into this in a bit, if I lend $100,000 to a retirement plan, we're going to want to see $15,000 still left liquid in the plan. And that doesn't have to be just sitting in cash. It could be in stocks, bonds, any mutual funds. It could even be precious metals. Something that's a liquid asset that you as a investor can access if you need funds for a roof repair, or there may be a tenant move out and you've got to do some make ready expenses. Maybe you've got to spend $1,500 just to get the thing ready to go for the next one. Those monies cannot come out of your personal account. They've got to come out of your solo K or IRA LLC account. So be aware on the funding side that you need more than just a 40% down. I tell people, honestly, you should have at least 55% of purchase price sitting in your entity you're going to use, because that will cover the 40% down payment. It'll cover those closing costs, and it will cover that 15% of loan amount reserves that we require. I'll add a caveat to that, and that is if you have more than one property in your plan, we drop that reserve requirement to 10% of your loans, because we figure you have more assets, you have more doors, the risk is spread out. So we're willing to go by with less reserves because you have more income coming in from diverse sources. So we don't need to see the reserves as much. But just as a rule of thumb, 55% of purchase price is a good rule of thumb that you should have in your account when you go to make a purchase or put together a contract. The second thing that we look at is, will the property have sufficient cash flow? I just mentioned a couple minutes ago that if Joe the plumber comes over and you can't pay him with personal money, you can't pay the loan payments on this loan either with personal money. So the property, there has to be enough money in your solo K to pay the payments. Well, where are you going to get that money? Hopefully you're not going to get out of your reserves. You ought to be making money. So we will finance properties that have positive cash flow only. We don't finance a property that just even breaks even. We want to see positive cash flow so that the property is accruing income and your solo K is growing. Is the property rent ready? And go ahead.
Can I jump in? I'm so sorry.
No, don't be sorry about it. Anytime.
Yeah, so let's define the terms. So when you say positive cash flow, in simple terms, that means after paying the payment on the non-recourse loan, after paying property taxes, that there's going to be a net number there.
Yes, and I will go through in my next slide how I get to that. So perfect. that will help you folks on the conference today to understand what I'm looking for there. We don't want to finance fixer-uppers or properties that really are a wreck, because here's the thing. The idea is that when you buy a property that we're financing anyway, it may be different for yourselves without financing, but if we're financing it, we want to see that income starting to come in relatively quickly. We have a requirement that says, hey, get us a copy of a lease within 90 days of closing. I mean, I think that's pretty liberal. We're willing to say, look, you're going to use your own reserves probably to make a loan payment here for a month or two while you're getting that tenant in there. Or maybe if you're all ready to go and a tenant's ready to go, you put that tenant in there and you're earning income right off the bat. That's what we like, because we want to have that property up and ready, because really, Allie, the property is going to pay the loan back. You're not paying the loan back. The property really is paying the loan back via the cash flow. So for us as a lender, it's property. That truly drives the deal. And then lastly, does the property make sense? Just common sense, does it make sense for you to have this kind of a property in your IRA or not? And if you're not a real seasoned investor, it probably doesn't make sense to get a 30-unit apartment building. You might be good to start with a single family or a duplex. And that's kind of what I mean by doesn't make sense. Just does the thing really make sense for what you're doing? I think if we go to the next slide, we'll be able to Touch bases, and we'll get to that in a second. Timing, these take about really the same amount of time to close as a regular real estate loan that you might be doing these days. We get to loan decisions very quickly. We're getting to a loan decision right now in about 24 hours. It's quick. And then there's no cost to you, just so you know, to apply for a loan. Once the decision is made, though, and then you want to move the ball forward, we ask that you send us an appraisal and processing deposit so that we have enough money to engage an appraisal firm, get them out there, get the thing going. But again, we're going to probably close in about 30, 35 days. I think, George, we talked about some things that, and I think maybe we'll touch bases a touch on this as we go in a little later. There are some issues that have arisen during COVID and this crazy market, and that is sometimes we're having a little issues getting appraisers to go out to properties in a timely fashion. So sometimes that 32-day close time is not realistic, and it's maybe taken the appraiser even 3 weeks to get out to the property just because they're so slammed. Often it may require an extension on the part of the seller and buyer to, you know, maybe the close date was September 1, but we couldn't even get the appraiser there till August 28th. Yeah, it might need a 10-day extension to September 10, what have you. But that is one of the things that has happened, and we're seeing a lot of that in the market. This frenzied market is that closing are taking longer simply because appraisers are just slammed. So generally,
no, highlighting that, yeah, because that's definitely one of my questions. Is I want to get your update from a COVID perspective, but maybe we'll go through the slides and we can get that at the end.
Let's do that. Yeah.
Okay.
I think the next slide, if we take a look, is probably going to get at that. Here's the idea is that, again, you know, normally when you go out to buy something, and I'll just say this in the personal world, you typically go to a lender, you show them your tax returns, they pull your credit, and they say, hey, you're pre-qualified for a $400,000 loan, go shopping. And there's really nothing incumbent on you to prove to the lender that the property itself, you're proving yourself on a regular loan. In the non-recourse world, we're proving the property. I mean, that's really, I think, the biggest distinction you can think about as investors. We don't care about you as a person. And I'm not saying that as in a derogatory manner. I'm just saying you as the person aren't buying the property. Your trust is buying it, and you're not even paying the loan back. Your trust is paying it back, but really the property is paying it back. So in this world, it's really all about the property. So what can derail it? If you overestimate your rental income and the rental income just isn't there. That's one thing. You know, you're saying you're going to go into this deal, hey, I'm going to get $1,500 a month out of this property. We go and have it appraised, and market rent's only $1,000. You know, that's really all it can sustain. So that can certainly derail a deal right at the end when we get the appraisal back, or we might say, you know, Bonnie, you're going to have to put in more money down to bring this loan balance down because the cash flow doesn't support a $1,500 rent. It does support $1,000, and so I can't do a $150,000 loan. I can do 120. So it may require, if they overestimate a rental in, to come in with some additional down payment monies to make the thing cash flow, because that's what we're trying to get back, is positive cash flow.
The positive cash flow, yeah, makes sense. Yeah, no, that's what they always say. Like, you should get you should find, you know, don't go shopping for home shopping until you figure out how much you can afford. You don't want to fall in love, have your spouse fall in love with the house, and can't get it. But here, this is the reverse. Like, you can fall in love with the house, but now you just got to convince Roger to lend you the money.
There you go. Another one that will kind of derail a deal is if you're buying a property in a neighborhood and you're you're picking the highest price one in the property. You know, maybe it's all renovated, but you're buying that $200,000 house, and it's really only a $140,000 neighborhood. You know, we do see that where people are. Sometimes they're flippers, sometimes they're renovators. They'll buy a house fairly cheap, fix it up, put it out there on the market, and for a nice profit. That's fine. Everybody's entitled to a profit. But I don't want to be financing the most expensive house in the neighborhood Frankly, I'd rather finance a less expensive house in a nice neighborhood than the nicest house in a less expensive. So we look at surrounding sales, and if surrounding sales are well below what this subject property is, we may say, look, we're either going to pass, or you put more than 40% down. We might say you put 60% down to get that loan down to where the value is where the other homes in the neighborhood are. Mm-hmm. High crime, you can fix up a roof, but you can't fix crime. So going into the deal, we look at crime stats. There's some good websites out there that aggregate crime. Trulia is one tool we use, and Trulia is a website that probably a lot of you folks at least look at. Trulia does have a feature on their website that does track crime, and actually Trulia aggregates several other websites, and so you can see what the level of crime is in the neighborhood. Good idea, because again, you don't want to buy a property in a high crime area because you're going to have super high tenant turnover and nearly zero appreciation. It's just going to be a hard asset to work with. So we don't like to go there. Poor condition of property, like I mentioned before, I don't want to finance a fixer-upper because we want to finance something that's really to throw off some income for you folks within 30 to 60 days, really. So you want something that's close. It doesn't have to be perfect. What we say is, we'll finance something that needs up to 10 grand worth of work to be rent ready. And that's a pretty broad, that'll allow some carpets and some new appliances and some paint and some tidy up and stuff. So we're not looking to finance a perfect property. It just has to be a good solid home and basically rent ready, or within 10 grand that you would use out of your solo K money to get it rent ready, then we're good with it. One thing that can wreck a deal as well is like I say, if this subject property doesn't cash flow positive, that's one thing. But maybe you have 2 or 3 other properties and they're financed and they're not making money. In fact, they're losing money. Mm-hmm. It's like, oh, I don't want to get involved with a borrower who's losing money on 3 other properties and I only have 1 winner, because those other 3 properties are going to drag down the ability of that borrower to service debt. So we look at all, when I say global debt service, we just look at all the loans that borrower would have within their solo 401k, not your personal debt. We don't look at that. But if you had multiple loans within the solo K, we just look at that to make sure you can cover them. And then lastly is inadequate reserves. You don't have the 10% or you don't have the 15% reserves. We're just not going to go into a deal. It's like starting a business without adequate capital. You're going to be hamstrung from the get-go. And if there's a hiccup along the way, the last thing we want to do is foreclose on a house. We want you guys to be successful. And if you don't have any reserves left when a problem arises, it can cause some heartburn. So let's just make sure you've got that reserves. That goes back to that 55% of purchase price number I was telling you up front. Sure. That accounts for those reserves. Yep. Next slide. This again kind of touches on our LTVs. We do up to 60% on the left side of your screen. Typically, most states, 50% on, and I'll get over on vacation rentals. So if it's a long-term lease property, typically we're going to lend 60%. If we go to a short-term, nightly, weekly, we'll lend 50%. Same with commercials. So that's basically the LTVs. We have a 20-year fixed rate loan that we offer on all types of properties. And we also have a 25-year adjustable rate that you can fix for 3, 5, or 10 years. And then the rate will just adjust once a year after the fixed rate period expires. But they're all fully amortizing loans. And there are rate caps on the 3 and 5 year arms to protect the borrower from too large of a rate swing. So they're all covered. Yep.
Yeah. Okay.
Let's see, loan offerings. We've got commercial properties again, I mentioned. We'll end up to 50% of those fixed and adjustables. And then to qualify, the debt service coverage must be 1.25 DSCR or greater. And I believe in the next slide, we'll see what that 125 looks like. And here we go. This is how we underwrite our loans. You can use this metric on anything you do in investment real estate, and it works. It's a pretty good tool. So, example, we have a $100,000 property. We're going to loan $60,000 on it and a 40% down payment. So in this instance, and this is a live example, on that $100,000 property, they're going to be able to achieve a $900 a month rent. So gross rent for the year, that's $10,800. We build in a 7% vacancy factor just because it's prudent to build in something. You can't assume properties are going to be rented 100% of the time, every day, every year. So 7% of gross rents, $756 out of an annual expense that we'll assign to this property. Taxes, this one had $1,250 a year in real estate taxes. It had a $600 annual insurance premium. Maintenance. Regardless of what you folks do out there in your maintenance, we allocate $600 per every 100,000 in asset value as an annual maintenance factor. In other words, I just take 0.006 times the purchase price, and I'm going to assign a maintenance cost to that given house. $600, if it was a $200,000 house, I would assign $1,200 a year maintenance. $300,000 house, I'm going to say it's going to cost you $1,800 a year to keep this property up. So maintenance factor, build it into your budgets. Condos have HOA fees. This one doesn't. It was a single family just in a regular neighborhood, but if you have HOA fees, build them in. Same thing on utilities. If you're running a nightly, weekly VRBO or vacation rental, you're going to be responsible for utilities because you're not going to have those tenants that are in there for one night paying any utilities. So you would be building in utility costs if you are doing a short-term rental. And then lastly, management. If you have an outside management company managing the property instead of you yourself, build that in. So this one, we took $10,000 just to run the numbers. We took $10,800 in gross income for the year. We subtracted these expenses, and so now we have net operating income of $6,514. NOI, keep that term in mind because that is the money that's going to be there to pay the loan. That's the money left after all the basic expenses of the property have been paid. And then the last thing to pay is the loan payment. So over on the left side, in this instance, the $60,000 loan had a interest rate of 5.5% and an annual payment or $4,421 per year. So we took the $6,514 of net operating income, divided it by the debt service, and the ratio is 1.47. That means that basically the debt payment is covered 147% by the net operating income, or to put it another way, net operating income is 147% of the loan payment. And that's what we like to see. Our metric is that net operating income is at least 125% of net income. This one exceeds it, 147. This is a moneymaker. Good deal. We're going to finance it. So use this in any kind of a residential example because it works. And you can create your own. You could create your own little Excel spreadsheet like this, or use an example like this, and it's going to work for any deal you do. The next deal I have as an example is a commercial one. This one, an individual bought a commercial building for $600,000. He put $300,000 down with his solo 401k monies. We financed $300,000, and we financed it at a 6.5% 20-year term, if you see on the left side. And so their annual payments on that loan were $26,841. So then on the right side, this person had it was a $5,000 a month lease. So that thing was pulling in $60,000 a year gross income. We subtracted out a 7% vacancy. There you go. This was a triple net lease. So the tenant pays the taxes, insurance, and maintenance. So in this case, I didn't assign any taxes to the investor because he didn't pay it. Then the tenant pays it. And same with insurance. There was a little piece of maintenance. I think it was in the parking lot on this one because the tenant typically is going to pay maintenance on the building, but the owner of the whole parcel had an obligation to maintain parking and stuff like that. So there's about a $3,600 maintenance factor there, and then some management down at the end. So, you know, net operating income was very strong on this deal. Only about $13,000 in real expenses because the tenant was paying the large overhead costs. So there was net operating income of $47,400. Divide that by the $26,008 in debt, and that's a 1.76 debt service coverage ratio. That's a very strong, profitable deal. One will be happy to finance because it's an income producer. So here's two examples, a commercial, the other one's residential. They're both live actual examples, deals we do, and pretty common for this kind of thing. I also see, you know, on apartment complexes, this one would be probably pretty common with maybe, let's say a 6 or 8 unit apartment where you're buying something for about 600,000, we're only in 300. The only difference is that you're going to have taxes and insurance to pay, and they may be quite a bit. So but your income may be higher too. But this would be a typical example, like if you're buying an 8 or 10 unit apartment building, because it's a 50% situation.
Got it. Yeah, those are very good examples. So and thank you so much for sharing this information. It's really educational, Roger.
Yeah.
The questions I have were just under the heading of COVID, of course.
Yeah.
Like, for example, my mind thinks about the rent moratoriums, you know, because isn't it true that in certain areas, the tenants are relieved from obligation to pay rent?
Here is the thing. They may be relieved in certain places, George, for paying rent. However, these loans are commercial loans. These are not consumer loans, and therefore,
what I'm not talking about the loan. I'm talking about if I invest in a residential property and I can't evict the tenant because of COVID, they stop making payments. Have you seen that, for example?
If they stop making payments, as a lender, I still expect my investor to make the payments, regardless of whether that tenant is got some relief or not. There is no relief on the commercial loan side for borrowers. And so, though there may be tenant relief, there's not borrower relief. So payments still go on, George, is the net effect. Is even if your tenants may not be paying you, we expect that you will make the loan payments. And again, that's why you have those reserves. Those reserves are there to make payments when times get tough or there's issues. And we had a few clients right at the very beginning of COVID that called us and said, hey, my tenant stopped making payments. And I said, well, I'm sorry to hear that.
Yeah.
If there's anything we could do, I would, but I can't. And that's why you have those reserves. So just there, that is a very good topic to talk about, though, because it's top of mind on a lot of people, and with the rent moratoriums and various things. But quite frankly, our investors have not had issues with their tenants not paying them. And this is whether it's the fact that they have good tenants or those tenants have remained employed. I don't know what it is, but we have had, I would say, no more delinquency during COVID than we've ever had. So those tenants have been making payments regardless, and our investors are making payments. So, I think we're about, well, you can't say we're about over this, because this new Delta variant is throwing some wrenches and issues out there that we may cause more heartburn. So I don't know, but just going forward, understand that if there are rent moratoriums and things like that, that we as a lender, this is specific to us, I'm not maybe saying every lender's like this in this space, but we're not going to offer any assistance. So just be aware of that.
It doesn't change, and it doesn't change this like I'm using this tool, for example. It's not like we have to assume, okay, we have to up our vacancy percentage.
No.
Okay, well, that's good. Well, you mentioned the appraisers, harder to find appraisers, extending the time to close. What other, if anything off the top of your head, you would say as a COVID type impact?
Yeah, and I'd say the biggest one, honestly, is the growth of Airbnb, VRBO, or short-term rentals. you know, when this COVID hit in about March of 2020, I'm kind of the lead lender and underwriter for our bank here. And I was very skeptical about short-term vacation lending. Well, within 30 days, those are the kind of loans and those are the kind of properties that everybody wanted, because travelers, they didn't want to go stay in a hotel with, you know, 400 other guests, but they did want to go rent a house on the beach for them and their safe ones and family, or their, you know, their safe community there they felt safe with. They felt great. Let's just go rent a house on the beach. And so, honest to goodness, the short-term rental business exploded during COVID. We have had far more requests for short-term rentals than I even imagined. And within 30 days, no, we're keeping this program rolling, because that was a very strong part of the market. People didn't want to stay in a high-rise condo on the Florida beach, but they'd stay in that nice home in Miami that they could have the whole house to themselves and their group, and they could rent the whole house out. And so they vacationed that way. So investors said, wow, if all these retail and traveler people don't want to stay at motels, they want to stay in VRBO, and then we better get into that market. So we had a lot of people, instead of buying long-term rentals, George, and all you out there in the audience, buy short-term rentals, because instead of getting, what is it, $1,500 a month out of a long-term, you can get $3,500 a month out of a short-term rental. Now, that's not sustainable all year round. There's high and low points, but generally, if you know what you're doing and then you're in a good area, vacation rentals make a lot of sense, and they can make a lot of money. And so we financed, I would say, quite a bit more short-term vacation rentals in 2020 and in 2021, because the demand is there for people to stay in their own self-contained property and not be in either a hotel or a large high-rise with 1,000 different tourists walking around, interacting in the hallways and all that. Not. They wanted to be more private, and like, oh, it's been a dramatic change. I've just almost been shocked. I guess the thing to keep in mind as you're an investor out there is, be sure, if you are going to go into the short-term rental business, that the community that you want to invest in allows that, because there are many communities throughout the U.S. and condo complexes that do not allow short-term rentals. So you don't want to go into a deal thinking, wow, I'm going to make a home run. I'm going to get $5,000 a month out of this house. And then they find out, no, this long-term rentals only. Some condo complexes have a 6-month lease minimum, so that they're not turning people over nightly, weekly. So just the caveat is, make sure if you're going to do a vacation rental that you know the local community laws and regulations for that kind of thing.
Great point. Yeah, because because the obligation to pay back the loan doesn't go away just because. No,
and here's the thing. And if you're basing your thing on $5,000 a month, and all of a sudden, no, it's a long-term lease, and all you can get is $2,000 a month. Whew, big difference in the cash flow on a property between $5,000 and $2,000. So don't be shocked, or don't just be sure that you think through all the potential issues out there. Go in with your eyes wide open, I guess, because that's my advice. I haven't seen a lot of extra delinquency in COVID. This has been pretty gratifying, or to a lender, to see that all you investors out there are making payments and doing well, and they are doing well. I mean, we do a look back on investors. You might say, well, how do you know we got 15% reserves in our account? Well, each year, in about April of each year, if you're a borrower with us, we're going to send you a letter saying, please send us your year-end December 31 account statement from last year and a profit and loss statement on that property. We just want to make sure you're making money and you have that extra money in your account. And they do. But I'm telling you, the P&Ls that we see, people are making money on these things. Yeah. So it's a very good way to invest some money outside the stock market. If you have plenty of that already going on in your personal life and you want to diversify some, this is a great way to take a portion of those assets and put them into a different asset class. And then you can use our money as a bank to make money, which is another benefit. So the other thing I would mention to you, George has a very good program there with his solo 401k trust. Those kinds of programs are not subject to the UBIT tax, which you may run across at some point in time in your learning about leveraging self-directed retirement plans. If you have a solo K, no UBIT. If you have an IRA, self-directed, it's a traditional IRA, you may have an UBIT obligation, but I'm not a tax expert, so I'm not going to go into that in depth, but just you may have a small obligation there, that's all.
Yeah, that's a good point. I mean, there's definitely, you hit the nail on the head at a high level, you know, that generally there's an exception for unrelated debt finance income tax when a 401k invests in leverage real estate, when it uses acquisition indebtedness. But that exception doesn't apply to an investment in leverage real estate inside of an IRA account. So that can be a big advantage. But as we mentioned at the outset, you know, I mean, obviously you got to consult with your tax professionals, et cetera, but definitely a factor to consider as you're weighing your options. Yep. I don't want to take, I know we had the technical difficulties. I'm so sorry. And I appreciate you spending so much time with us, Roger. I want to give you a chance to share your contact information. I think It's on this slide here.
If you look at the lower right of this slide, it says myiralender.com. That is our web address. And my personal email, which if you have any question, just reach right out to me. It's roger@myiralender.com. And here's a phone number up here, 800-908-8845. So feel free to reach out to me. If you have any question, call, email, don't hesitate. I'll be happy to send you my program details. I'm here to help. Any other questions from the audience, George, that are out there that you were fielded?
If you don't mind sticking around maybe for a few more minutes, that we do have questions. Yeah, please Zoom them over through the Zoom chat feature and we'll field them.
It's been a pretty exciting year. I know that real estate prices have gone up a lot in many markets, and that's a little bit of a challenge. I guess I'd say that's perhaps one of the biggest challenges for investors is they don't want to overpay. Mm-hmm. and they got to make money. And where the retail investor who's going to live in the house, I call them retail investors, those are the folks who are actually going to buy a house and live in it. They may be willing to pay that higher price. They're getting, 2.5–3% loan money. They're going to live there. They're willing to pay that high price. But an investor, once you start working through that debt service worksheet, the higher the price you pay, the less the cash flow, generally speaking. So a lot of investors, the tricky part right now is finding good properties to buy that will cash flow well, because a lot of those properties were driven up in prices in the spring and early summer. That's the go-go part of the real estate market. So a lot of the market has already gone up. Those have sold. The challenge is out of finding properties that cash flow well, that an investor's not going to overpay for. And I write a lot of pre-qual letters. I can write a pre-qualification letter if you want to put an offer in on a property. I can put one together usually within a couple hours, and that's helpful. And I can write many of them because the pre-qual offer is specific to that property. So I'll write a letter that says, Joe Smith's trust is pre-qualified for 123 Fifth Street on this town and so many dollars, and I can assist that way. And if that deal doesn't stick, I'll write another one. But all I'm saying is it's a bit of a challenge right now sometimes for investors who are not willing to overpay, to get price properties that work from a cash flow place that they want to put in there.
Yeah, that's interesting. It's kind of it sounds like it might be a little bit counter-cyclical or counterintuitive just to the casual observer. You would think, oh, prices are going up, it must be good, but it's actually maybe making it, like you said, harder to find that investable property.
That is correct. And although now, in fall coming into winter, historically prices soften, they'll drop probably as much as 5% off of their June highs. That's the nature of real estate. And so those prices are going to start coming down now, October, November, December. That's a good time to buy as an investor because most investors don't have to worry about kids in schools. They're not buying so they get in by August, so their kids are in the school district in September. They're buying so they have a rental property. And there's some sellers out there who want to get some deals done out of their hair before the end of the year. So we always do see a pickup in activity, October, November, December, people doing those end of the year deals. So there's often better deals. There's often better deals out there in terms of buying and in that time of the year.
Makes sense. Yeah. We did get a question here. I'll field it. It's really more of a solo 401k question. Thank you so much for chatting it over. I'll read it in case people can't see it. Can FNC free and clear properties owned as individual be deeded to the trust and then cash pulled out from refinancing? So the answer is no. You cannot contribute property that you own in your own name to the solo 401k. So
quick on that point, that brings something else up very nicely that fits into this. Refinancing. We have been doing a lot of refinancing. There's a lot of properties that people bought in their solo Ks, IRA LLCs in the last 3, 4, 5, 6, 7, 8, 9 years, and they're paid off. And you know what prices have done over the last year or two? They have skyrocketed. And so good on them. All these investors have assets that have gone way up. And so what they're doing is they're coming back to us now and saying, gee, Roger, we would like to pull some cash out of this property. It's gone from 200,000 to 300,000. We don't owe any money on it. We'd like to pull 150,000 out of this property so we can go buy more. And so the demand, I guess that's another thing that they will touch on that has helped, is the demand for refinances during the COVID and since has been dramatic. People own assets. They've gone up, they're re-leveraging so they can buy more. And a cash out refi for us is the same cost to you as an investor, the same process, takes the same 30 days. The prices are the same, the rates on the loan are all the same. So whether you own a property now and want to put some leverage on it, own the property within your trust. Like George says, you can't deed it over to the trust and lever it. But if you own something in your trust now, maybe you have just a very little debt on it, you've paid it down and the price has gone way up, you can come back and put more debt on it. We do that a lot. I'd say probably nearly half of what we do is cash out refinancing, where people are taking assets they own, leveraging up, loading that account up with cash so they can go buy more property.
interesting. And we have another follow-up question from someone else. Thank you so much for posting this follow-up question. Can a property with a recourse loan within a solo 401k be refinanced without triggering UDFI? So that's a great question. That's certainly one that it's going to come down to whether or not the debt is considered to be acquisition indebtedness. So that's the language of the exception that applies to solo 401ks. So you would want to review that with your tax advisor, a little bit beyond the scope of this presentation. So it's going to come down to those facts and circumstances.
Makes sense.
Yeah. So,
anything else?
yeah, we got another question here.
Okay.
And it sounds like a follow-up to your point. Does the cash out of the trust-owned property stay in the trust for additional property acquisitions? Well, I'll first answer it from a 401k perspective. So, of course, if you're taking cash out of your plan, then you've got to consider the solo 401k distribution rules, right? There's triggers that would have to be met. There's withholdings that have to be done. You know, you've got to pay taxes on it. So I think what Roger was talking about is what he sees is that people refinance the property in their solo 401k and then buy more property in the solo 401k.
That's correct. The assets in the 401k, they've leveraged the money, has to start by going back into that solo 401k. Now, what they do with it beyond that is, again, up to them. But when the property is leveraged, those loan proceeds go back to the entity that owns the property, which in this case would be the solo 401k trust.
Yep. So, okay, fantastic, Roger. Any closing comments before we?
I just want to thank you, George, and all the people on the presentation today for your time. I always enjoy working, especially with George, because he's got a big background in knowledge, but he also has a good background in real estate and knows this. So he's able to, I think, provide a good platform for you folks. And I'm always just willing to engage with your platform and be here as a helpful asset. So think of me as just as a helpful asset or partner in your investing endeavors. I'm here to help. So I just want to thank you all for your time today, and thank you especially, George, for your time and setting this up. Really appreciate it.
Yes, sir. Thank you, Roger. Thank you for everyone for your participation. Thank you so much. Have a great day. Bye-bye.